Thanks for having me today. Really enjoyed listening to Steve's remarks on real estate and appreciate the second question of what about infrastructure and the response that it's important. I think it's a great segue into this presentation. Maybe if we just take a minute and think about infrastructure, really to continue to thrive into the future, we need strong foundations. Resilient infrastructure really provides that foundation. Provides us with power and resources, connecting people and communities, facilitating ideas and innovation, and enabling our economies to grow. We really think there's a $100 trillion investment opportunity that sits in front of us, and now is the time to do that, to rebuild. But how do we know where to invest that money? We think it really starts with three key questions. One, how do we drive the energy transition? Two, how do we better connect communities and people and close the digital divide? And then three, how can we transform our economy to big investment to lead to these big investment opportunities? So today we're going to talk about what infrastructure is, why it's a particularly compelling investment opportunity today, given the diversification benefits it brings and the inflation offsets. And we're going to talk about some of the things that are really driving this $100 trillion investment opportunity and how you can capitalize on that. I'd also like to personally say how excited I am to be able to be here in Texas today. Our infrastructure funds, the first two investors were actually Texas-based investors. We've invested more in this state than any other state or country in the world. So Texas is pretty important to us. And really want to thank you again for having me here today. So let's start with what is infrastructure as an asset class. Infrastructure as an asset class emerged in the mid-1990s and has continued to grow over time. In 2021, over $136 billion of infrastructure capital was raised across 100 different funds. Infrastructure is typically considered alongside other private market asset classes such as private equity and real estate, but includes characteristics that make it unique and is meant to provide stable, reliable returns across economic conditions. Those returns typically include a consistent cash yield component in addition to capital appreciation, and they often benefit from built-in inflation protection. More formally, infrastructure is defined as the basic physical and organizational structures needed for the operation of a society or enterprise. So, the roads you traveled on here today, the pipes that contain the water that you needed to shower, the electricity that gets delivered to light this room, the fiber networks that make it possible to communicate with friends and colleagues all over the world are all perfect examples of infrastructure. When we think about infrastructure, we really break it into a few key categories. It really starts from a risk perspective, core plus, value add, and opportunistic. The returns range from 5 to 7% on a net basis at core plus, all the way to 15% plus for opportunistic. From a sector perspective, the key sectors that we're talking about here are utilities. So think about the gas pipelines that are delivered to your home, electricity utilities, water utilities, major components of energy infrastructure. So both conventional and renewable power generation assets, midstream pipelines that transport oil and natural gas all around the country and the world, transportation assets, ports, terminals, toll roads, airports, any large class of infrastructure there. And then more recently, the sector has really expanded to include digital assets. So things such as telecom towers, fiber networks, data centers are all getting a lot of attention in the infrastructure space. When we think about how to invest in infrastructure, there's really three key categories that we think about. Those pillars really include sourcing, structuring, and value creation. So as people think about investing in the infrastructure space from a sourcing perspective, how do we find the investments that actually go into our fund? There's a couple of different ways that people do it. You can participate in broad auctions that are run by investment banks or large government entities. Those typically are for more core plus assets that are incredibly large and really have to go through a competitive process for various reasons. The other way that we think of doing it is really effective is really developing a solid network of institutions and potential partners. What we've done over the years is we've tried to identify, who are the 600 most likely partners that own infrastructure assets or need access to infrastructure assets and are going to be willing to put in place a long-term contract with us. We spend the majority of our time, and a lot of infrastructure funds do this, trying to negotiate transactions with those counterparties where we can essentially partner with them to own infrastructure that they need access to, that they need owned by a safe pair of hands, but that they don't necessarily need to utilize their own capital with. That process takes time. We don't just show up at a company's door and offer to buy some of their infrastructure and they hand it to us. You really have to develop a relationship with them, and they really have to understand that you're going to be able to operate that infrastructure efficiently. A lot of the times you're talking about, terminal operations or pipelines that are critical to the success of that underlying company. As we're having those discussions with the company like that, we're looking at trying to structure a transaction that, one, works for the company, but two, works for infrastructure investors. So when we think about that, and this is pretty consistent with a lot of infrastructure, you're typically looking to put in place long-term contracts. A lot of the times those contracts benefit from inflation. So when you think about a potential investment opportunity, it all starts with that long-term revenue contract. That's what really provides the stable foundation for any potential investment. Many infrastructure assets, when you move down the income statement, many infrastructure assets then have very attractive operating margins. So low operating cost as a result of the amount of capital that's put in. And the other thing we're looking to do is put in place long-term fixed price amortizing debt. So we're not taking a lot of interest rate risk in infrastructure. We're really trying to lock in that fixed price debt. And what we see that does from an infrastructure perspective is if you have locked in revenue, you have low operating expenses that are also contracted, and you have fixed price amortizing debt, it creates a really attractive dividend yield profile for our investors. And that's really critical to the success of a lot of infrastructure. The other thing that it does is as you're paying that debt down over time, you're building equity value that way. So when you think about the fundamental characteristics of an infrastructure investment, you're really de-risking. It's a really low-risk investment over time as you're achieving that annual dividend yield each year, and you're also building equity value through the amortization of that debt over time. And then finally, the last area that's the key pillar to success for infrastructure investing is really active value creation. So infrastructure assets are not assets that you simply go buy, put on the shelf, and you hope the cash flows come in. Throughout our ownership period, people are trying to optimize these assets, whether that's trying to increase lease rates on a pipeline or taking advantage of underutilized capacity for a piece of infrastructure, or simply adding additional contracts that are accretive to underlying returns. That underlying active value creation ends up being very critical. So from a partnership perspective, we're often partnering with strategics that help us drive that value creation, or partnering with management teams that can drive that value creation, or working with a team of our own asset managers internally to really try and improve these assets over time. When we think about that value creation story, it really starts at the beginning of due diligence. During the due diligence phase, you're working with your partners to identify any potential red flag areas that may make it difficult to invest in a particular asset, but you're also looking for opportunities where you might be able to optimize that asset over time. In that due diligence phase, we're taking note of all those things. And then during our ownership period of typically 7 to 10 years, we're looking to implement those things so that not only do our assets perform better during our ownership period, but when we ultimately go to sell them on behalf of our investors, they're going to be more attractive to potential acquirers and operate more efficiently. As we think about some of the key trends that are really driving this, driving the investment opportunity in infrastructure, I think the first key trend, and this is driving a lot of things, is the energy transition. I think over the past 10 to 15 years, renewables and the energy transition have gotten a lot of focus from the popular media. And renewables are really important. You know, there's a great role for wind and solar. But I think when we think about the energy transition, there's three things that we all want for energy. And, you know, being in Texas, you all are aware of this. We want our energy to be affordable. We want our energy to be available. It needs to be available 24/7. And we want our energy to be clean. The interesting thing is, there's no single source of energy right now, or really in the foreseeable future in the next decade, that satisfies all three of those criteria. We really need a diverse set of energy sources as we move forward on the energy transition. So again, a lot of the attention historically has been really on wind. As we think about decarbonization going forward, we think natural gas plays a really important role. That role is twofold. One, it's an important transition fuel for all of us. We've seen what happens when natural gas systems break down and we have rolling blackouts. Two, from a decarbonization perspective, a lot of natural gas is actually being transported via LNG vessels to Asia. It's hard to believe, but in India and China, about 50% of their electricity generation still comes from coal. When you think about replacing that coal generation with natural gas, you're actually reducing CO2 emissions by about 60%. So natural gas has a really important role to play there, and a lot of that natural gas is coming out of Texas and being transported to Asia. The other important role for natural gas is providing baseload and peaking power generation. So as we think about markets that have focused on wind and solar, one of the things that people become acutely aware of really quickly is that the wind doesn't always blow and the sun doesn't always shine. And we talked a minute ago that one of the key criteria we need for our energy supply is 24/7 availability. The solution to that is natural gas peaking power plants. So we see a significant opportunity as the renewables build out continues for more natural gas to be used to really fill in those pockets of supply when wind and solar generation isn't available. So that's really, really important. The second key trend that we see is decentralization. And for this, a big part of this, what we're seeing is a greater outsourcing by strategic companies of their key infrastructure. So I mentioned just a minute ago that we spend a lot of time developing relationships with companies to try and help them outsource their infrastructure. We're increasingly seeing companies recognize that they don't necessarily need to own all of their infrastructure capital. There may be better uses for that capital, higher returning uses. So as you think about an energy company here in Texas that's potentially drilling oil and natural gas wells and also owns a midstream system, they may decide they don't necessarily need to own that midstream system. They need access to it so they can transport their oil or their natural gas through that system, but they don't necessarily have to have their capital tied up. A lot of the times they're making the decision that it's much more efficient for them to let someone else build that system for them, or let someone else acquire that system from them, to have a contract so that they continue to have use of that system, but to take that capital and redeploy it into higher returning opportunities. I think the third key area where we're seeing a significant amount of activity is in digitalization. On an annual basis, the amount of data consumed by individuals increases roughly 30% per year. So if you think about that, every 3 years, the amount of data consumed by an individual is doubling. The amount of infrastructure needed to transport and store that data is also increasing significantly. We're seeing a number of opportunities to invest in data centers, in fiber networks, in telecom towers, all focused on the digitalization of our economy. Maybe before we go into a couple of examples, I think I just want to touch on one key thing, which is, why are people so focused on investing in infrastructure? I think, one, there's a lack of correlation to other asset classes, such as public equity and debt markets. So in periods of market volatility, that's critically important. Two, there's underlying inflation protection. Many of the contracts that are put in place, or regulatory mechanisms that are utilized to govern these investments, have built-in inflation protection with annual increases linked to CPI. And then three, these are intrinsic stores of value. When you think about the significant amount of capital that goes into these, they typically retain their value given the significant need for such assets. And I think with that, maybe just to bring some of this to life a little bit, I'm going to talk through just a few of the recent investments we've made to give you a sense of the types of infrastructure investments that are out there. So this first investment, Navigator CO2 Ventures, this is a partnership that we're doing with the Navigator management team. Our off-taker here is Valero Energy, a San Antonio-based company. What you see there in that picture is actually a biofuel refinery. So biofuels are relatively environmentally friendly. Typically, your ethanol is blended into gasoline and you're reducing the CO2 emission profile. So a lot of people appreciate that. One of the things that doesn't get as much attention is that biofuel refinery and the creation of ethanol actually creates a 100% pure CO2 stream that is typically just vented into the atmosphere. So obviously that's not the best thing for the environment. Biofuels are still relatively friendly, but they could be more friendly. I think as Valero recognized this, they recognized the environmental impact that it has, but they also recognized the economic impact that they could have if they were able to fix this and not vent that CO2 in the atmosphere. So as we were working with Valero to try and determine if there were opportunities where we could potentially help with their infrastructure needs, they brought this up. And I think the idea that came together was to create a system to capture that CO2 off of the biofuel facility, transport it through a series of pipelines, and store it underground permanently in a well. When you think about why you would do that, one, there's obviously the environmental attributes, but like many things, it also often comes down to the economic benefits, and there are some significant economic benefits of doing that for Valero. So there's a low carbon fuel standard that they're able to achieve in California for selling that cleaner ethanol. There's also a federal tax credit that they can receive for sequestering that CO2. So we worked with them on the economics. Ultimately, we reached an agreement where we would build this 1,500-mile pipeline system throughout the Midwest. It crisscrosses to their various biofuel facilities. It then travels down to Illinois, southern Illinois, where that CO2 is permanently sequestered. In exchange for that, Valero provides us with a long-term, 12-year take-or-pay contract. So this is really consistent with a lot of infrastructure investing. We're not taking any risk from a volume perspective. We're not taking any risk from a pricing perspective in terms of that contract that Valero provides. Valero, in exchange, gets the benefits of the fuel credits and the low carbon fuel standard. So it's a little bit of a riskier proposition. They're relying on a government subsidy, but they're also getting a little bit of a higher return. Whereas the infrastructure investment is lower return, lower risk. That's what we're focused on. One of the other interesting things that's pretty consistent with what we're trying to do as we think about that asset optimization is the Valero contract basically provides the baseline foundation for building the system. If we don't bring on any other contracts, we'll get to the low end of our target returns. It'll be an okay investment for us. It'll be a great investment for Valero. But we think there's a lot of upside opportunity here. The capacity that Valero needs on this system represents only about 20% of the total capacity that's going to be built. So we've already run what's called an open season to bring additional customers on. We've had 2 sign up already. And we expect that as people become more and more focused on CO2 and sequestering carbon dioxide and the benefits and the technology improves, we'll have the opportunity to continue to run more CO2 through our pipeline system. So again, that's just an upside opportunity. We have our base case returns protected through the underlying contract, but that's really what we're trying to create with infrastructure investments, is downside protected returns with asymmetric upside through value creation activities. Maybe just to touch on another one. So GasLog is the largest owner and operator of liquefied natural gas vessels that transport natural gas from high gas producing regions such as Texas, the Middle East, Australia, to gas consuming regions such as Asia and Europe. Obviously, the need for natural gas in Europe is something that's gotten a lot of attention recently, given the devastating activities or devastating events that are occurring in the Ukraine. GasLog is one of the providers of natural gas to Europe and also to Asia. So this was a publicly traded company that we ultimately took private. Very similar. It has long-term contracts. So all of the vessels within GasLog have 8-year contracts with inflation protection, or on average 8-year contracts with inflation protection. It was, sourced through a long dialogue with the management team, where we got to know the management team. They ultimately decided that they wanted to go private, and we created this transaction bespoke. And that management team partnered with us. So the management team and the founding family continues to own a large part of this business, and we continue to look for increasing activity. Since we acquired this company in February of last year, we've actually signed contracts to bring us 6 additional ships online, with many of those ships actually supplying natural gas to Europe as well. So again, fundamental infrastructure has long-term intrinsic value. These are kind of 30-year life assets, long-term contracts. That's really what we're trying to accomplish. And then maybe just an example of one of the outsourcing trends. So Dow Chemicals, one of the largest manufacturers of chemicals in the world. In our conversations with them, they actually did reach the conclusion that they didn't need access to some of the ports and terminals that they owned. We actually reached an agreement with them to acquire all of their ports and terminals along the Gulf Coast. These facilities are actually integrated into their own manufacturing facilities, so they're really critical to Dow's success. They needed a safe pair of hands. We partnered with Vopak, which is one of the largest and oldest terminal operators in the world. We took back a long-term contract from Dow. So again, inflation protection in that contract, with just the portion of Dow's revenues. We're kind of getting to the lower end of our base case returns. And then we're also working with Vopak and our management team to really optimize this, bringing in third-party contracts so that we can continue to grow this business over time. So, this is a kind of a good example of the types of investments that we're looking to make. Maybe one more, just because it's so critical to Texas. Our most recent investment, we actually acquired a natural gas utility based here in Texas. They serve primarily the suburban areas just outside of Dallas, Houston, San Antonio, and Austin. So as we were talking about some of the real estate trends, or as Steve was talking about some of the real estate trends and migratory patterns of people moving to Texas, this utility we think is perfectly positioned to really capitalize on those trends. When we acquired it, they had a little over 20,000 customers. Part of their business model, interestingly, is signing long-term contracts with home builders and home developers to provide natural gas for those homes as they're built. So we actually have about 160,000 contracts to supply natural gas to additional homes as those come online. The other part of their business model and what they realized was that it was important for those home builders and home developers to really deliver homes not only with natural gas, but also with digital, which people think of, or fiber, which people think of as the fourth utility. So in that same trench line that they're laying a natural gas line, they're also laying a fiber line. So you're literally seeing the physical convergence of digital and energy coming together. And very similarly, they have long-term contracts to supply fiber for a number of those new homes coming online. So with that, I think in summary, I think infrastructure remains a really attractive asset class from a diversification perspective. There's a lack of correlation to public equities and debts. There's a really significant inflation protection. And we see a significant investment opportunity in the years ahead. So thank you again for having me, and happy to take any questions. Sure.
Just out of curiosity, the biofuel, the CO2 that's output on that, you said you pump it into the ground. You pump that into natural things, or are there tanks under the ground?
So it's actually, interestingly, the U.S. is uniquely positioned for CO2 sequestration. We actually have some of the best geology in the world, so we'll end up being a leader in it. These particular wells are based in southern Illinois, and they're existing salt caverns that it's pumped into, so it's all natural. It's actually under so much pressure that natural gas, that CO2 is liquefied, so there's no chance of it escaping. Sure.
Can you discuss exits, like how has the new approach to how you exit changed significantly from 10 years ago?
Yeah. So I think it's a good question. I think the strategy around infrastructure and investing and exits, it really hasn't changed significantly. I think in terms of the way we look at exit, I think what has changed, we've always thought about how are investors going to look at this investment in the future, and when we look to sell it 7 to 10 years from now, what are they going to be focused on? I think increasingly they're focused on the energy transition and how are these assets going to play. So as I mentioned, we think natural gas continues to be a very important long-term transition fuel. Same thing, there's going to continue to be a need for refined products over the next 10 years plus at least. But when we're looking at, we'll just take a refined products terminal as an example. When we're looking at a refined products terminal, we can have a pretty good sense of what our cash flows are going to look like during our hold period. When we're starting to think about what the cash flows are going to look like for a prospective investor, we're underwriting and looking at more draconian cases where potentially refined products go away more quickly, just as one. We're also thinking about how our assets can be repurposed and what we might be able to do there. So as an example, a lot of refined products terminals will look at, okay, is there going to be the opportunity to potentially transport biofuels? Or for instance, the utility that we own in Texas, the natural gas utility Centric, when we think about natural gas flowing to people's homes, we think that continues for a long time, but we're starting to look at opportunities to blend that natural gas with hydrogen or renewable natural gas. And hydrogen may not be Hydrogen likely won't be economic during our hold period, but having the ability to technically understand how we can blend that so that we can think about that for our exit and how a prospective investor is going to think about that does end up being critical. So I think that's probably the biggest thing that's changed is the energy transition has become so dynamic that we have to take that into consideration for our exit.